Using balance sheets and income statements to assess performance. Okay, in this presentation we're going to look at the balance sheet and the income statement, what it actually means to an organisation, and some of the keywords that you may see in your exam. Okay, an income statement typically shows the profit and loss of an organisation. You normally conduct this yearly. It used to be called the profit and loss account, so you can bear that in mind. All it shows is the profit or loss of the organisation, and normally done at the end of the year. This is what a typical income statement would look like. Now, if you look at this information that we got there, you can calculate the gross and the net profit margins, and you could assess how the business is performing based on a profitability figure. This could inform us maybe how well the organisation is managing its costs, or it could provide us an indication of how competitive the market is. So we can look for some data at this and make decisions. That's really, really important. That's how you get the marks in the higher level ranges for the exam. So let's actually do that. So as you can see there, these are two formulas you should know. Gross profit margin, net profit margin. So as you can see there, my gross profit divided by my turnover gives my gross profit margin times 100. And my net profit margin is my operating profit divided by my turnover times 100. So in the first example there, I've calculated they've got a gross profit margin of 46.9%. So fairly good. They're making nearly 50% on each item they sell. Not a bad margin at all. So maybe it shows that the market is actually performing quite well for the organisation. It's not too competitive. It's not driving down margins to a really low level. Their net margin is 20%. Okay, so that's their operating margin, remember. So net profit margin obviously says operating profit. So again, not too bad. They're making 20% at the end of it all. Sounds like they're in a really good market in this case here. So I've made some decisions already from the organisation. And by making those decisions, I'm showing a higher level of understanding. Let's look at the balance sheet. Now, the balance sheet is a statement which shows the assets and liabilities of the organisation. Now, remember, assets are things you own, liabilities are things you owe. Think about liable. You're liable for something. You're responsible for something. This shows what a business is worth at any particular time, right? So it's any point now. Now, I've used a camera there because it's a snapshot, it's a picture. You can do this whenever you like. Typically, you do it at the end of the year when you do your profit and loss account or your income statement. However, you can actually use the balance sheet whenever you like. You can take a picture of the business at any point you want, looking at what they owe and what they own. Now, a balance sheet typically looks like this, as you can see. So that is a typical balance sheet. You've got your non-current assets, you've got your current assets, your current liabilities, your net current assets, your non-current liabilities, your net assets, and your total equity. So what do all these mean? Let's try and break it down into smaller bits. Okay, so your non-current assets, because it says the word non-current, these are items a business owns that would take longer than a year to turn into cash. So non-current means longer than a year. So these are assets that you've got, like machinery, like your building, that it would take you probably longer than a year to sell and turn into some money. So bear that in mind. These are assets that you've got, probably your most expensive assets, your biggest assets, but it's going to take you longer than a year to actually turn them into money. Then you've got your current assets. Now, current, unlike non-current, means within a year. So these are items that you can turn into cash within a year. Typically, cash is the best current asset because you can just get it straight away. Debtors, people who owe you money. So they can be turned into cash typically pretty quickly. And stock, you should, in theory, be able to turn that into cash pretty quickly. Okay, then you've got your current liabilities. Now, this is money that the business owes, and it has to be paid within a year. Because remember, it's current again, current liabilities within a year. So typically, you might have to pay your suppliers. You may have to pay interest on any money that you borrowed. You may have to pay your overdraft back within a year. So again, this is money you owe in the short term. And then, of course, you get your non-current liabilities. This is money the business owes, which needs to be paid back longer than a year. So these could be like your bank loans, your mortgages, your director's loans. These are all long-term debts that take longer than a year. And of course, this forms what goes into what the balance sheet where it all works from, and it goes into this thing called total equity. And total equity is basically the capital invested in the business. Now notice that the capital invested in the business balances with the net assets in the business because it's a balance sheet. You've got to have a balance. So the money invested in the business balances with what's actually in the business, what assets are there at the moment, and that's why it all balances. That hopefully explains how you make up the balance sheet and what goes into it. Now, you've got this thing called net current assets. Now, net current assets, if you notice, is calculated by your current assets minus your current liabilities. That's the working capital in the business. That is working capital. That's all the money that's there at the moment. It's a short-term amount of money available in the business at this point now. You want that to be a positive. If that was a negative, there is a severe liquidity problem in this organisation. In the short term, they have got severe problems. They may need to take some form of action to try and eradicate that problem. Okay, now one of the other words you're going to see is what's called profit quality. Now, any business you probably expect wants to make a profit. However, you've got to start thinking about, is it a good or a bad profit? A good profit quality is one that's sustainable. So, for example, it's one that comes from selling more products. Naturally, the more you sell, the more you make, and it's sustainable. You can keep doing that, hopefully. Where a poor profit quality tends to be unsustainable profit. Like if you sell off your assets, you sell off one of your machines, or you sell off one of your buildings. Now, there are reasons why you may try to do what's called a poor profit quality. If you're looking to sell the business, then you may want to try and increase profitability. And one option of doing that is to sell your assets. If you think about a classic example of that, Woolworths was an example of that. Woolworths sold off lots of the buildings they owned. They did sale and lease back. So they increased their profitability in the short term, but in the long term they suffered, because then they increased their amount of liabilities, the money they had to pay out, and of course the business ultimately in the end failed. So you want a good profit quality. Don't be afraid to comment on the quality of the profit that's made in your exam. It shows a good level of understanding, so really try to get in the habit of doing that. So look, is it good profit quality or poor profit quality? Another word you're going to have to think about and use quite a lot is this word depreciation. Assets will not retain the same value you paid for them initially. It's called depreciation. You think about buying a car. You buy a car, it might cost you £14,000, but in 3 years' time you can only sell it for £7,000. That's depreciation. It's basically a loss in value of an asset. And it's got three causes, really. Usage, the more you use an item, the quicker it depreciates. The longer you keep an item. And what they call obsolete or technological change, so change in the market. When you've got an item that actually falls behind what's required, then it loses its value. Think of things like the PlayStation 3. The PlayStation 3 lost a lot of value when the PlayStation 4 came out. It would be the same with the iPhone 4. That would have lost its value as soon as the iPhone 5 came out. And you're seeing now probably in the actual example of the phone shops, they're trying to sell off their iPhone 5S's as cheap as possible, as quick as possible, because they know a new model's coming out soon. So they want to try and maximise the returns as they can. So that's depreciation. And depreciation is bad for an organisation, but it's something that you can regularly actually not fend off unless you're going to lease items, for example, where then you're not left with the depreciation and it's passed on to somebody else. But you normally pay for that, for the privilege of that. And then you've got this thing called profit utilisation, which is how do you use the profit you make? Do you retain your profit so you keep it in the organisation? Now, the advantage of keeping it in the organisation is you can use that money to grow your business and there's no cost to it. It's borrowed money. Shareholders, though, do not like this, not short-term shareholders, because obviously that's some of their profits that you would normally pay them in a dividend. Do you give a dividend to the shareholders? Now, the advantage of giving the shareholders a dividend is it keeps them happy, and you may get more investing in your organisation. As a result, you get more capital to use, which is free capital, not borrowed capital, so you can grow your organisation. Or do you invest it back in the organisation? Do you actually purely keep investing and ploughing all your profits back into the business, giving nothing to anybody? So you are basically growing the organisation continually. Doing this could be a sign that the organisation is getting bigger and it's going to become more competitive and it'll become a market leader. However, in the long term, you have to ask, will the shareholders stick with the organisation? Will you be able to maintain that position? Will regulation get in the way? So there are lots of considerations you've got to think about what you do with your profits. Okay, you should now have a better understanding of the financial documents that an organisation produces and some of the information that can be obtained from a set of accounts. Don't forget to follow me on Twitter at BeeBusinessBee and subscribe to my YouTube channel. And remember, you can tweet me any areas of business you want me to cover in the future, and to check out my website, BeeBusinessBee.co.uk.